Thank you, Kelly, for that introduction. Thank you, everyone, for coming out this morning. I know there's a lot of traffic, myself, Nathan, everyone, maybe. So it was kind of appreciative that no one turned around and kind of just said, forget TOSI. So I'm going to be talking about a few different things today. We're starting off talking about TOSI and a little bit of background just on what income splitting exactly is. And really how these new tax rules with TOSI, which stands for tax on split income, how it exactly applies to you. And we're going to talk about the small business deduction. That's the benefit of having what's called a Canadian controlled private corporation. You get this low rate of tax. Current year, it's about 13.5%. Next year, it's going to be 12.5%. And certain changes that are going to happen that are going to actually negatively affect that and possibly reduce or even eliminate that benefit. Then we'll talk about the RDTOH, refundable dividend tax on hand. This is a tax attribute account, certain changes that are going to be happening to that. We'll then jump into certain rules that are changing with trust disclosures and certain penalties that are going to come into play and how exactly to avoid it. And we'll wrap things up by just talking about kind of a general discussion of what all of this means and how exactly it applies to you and how us at Zeifmans can help you. So TOSI, tax on split income. So a little bit of background just on exactly what is income splitting. So the Canadian tax system uses a marginal rate of tax. So if you have two people, so picture you have on one side of the street you have let's say the doctor. He's making $200,000 a year. And his wife isn't working; she's a stay-at-home mother. And across the street, you have another couple. They're both working. They're both making $100,000 each. So the couple that makes $100,000 each is going to pay less tax than the one doctor who's making the 200, even though the cash amount that they both made essentially is the exact same. So there's an incentive to really split income with as many people as you can. So if you have children, parents, anyone you really can, the goal was always to kind of split as much as possible. So under the old rules, obviously this was kind of finance found this abusive. They put into place what was called the Kiddie Tax, or that's kind of what we referred to it as. This basically applied to minors, so anyone under the age of 18. It was put in place to stop income splitting with minors. Finance found it abusive if you could split your income with your 2-year-old. And this predominantly is referring to dividends from private corporations. That's generally where this is going to apply. So they didn't like the fact that you were able to pretty much set up a family trust, own shares of a company, and split income with your 2-year-old, your 4-year-old, your 6-year-old, so forth. They found that abusive. So Kiddie Tax was put into place to stop that, to curtail that. But obviously what, as creative tax professionals we did is pretty much we just started paying it to the 19-year-old, the 20-year-old. They were in school, a lot of tuition, elderly parents, they didn't have a lot of income. So we just started income splitting elsewhere. So this new TOSI, or tax on split income, this is coming into place to basically curtail that plan. And it's also important to note that when tax on split income, this TOSI applies, you're not being taxed just where your parent was. So say that first case, the $100,000 couple. So if you were to split income, you're not going to be taxed as though you're at $100,000. You're actually going to be taxed at the top rate. So as though you had $200,000 of income, you're at the top 53% rate. So it's extremely punitive, and therefore, obviously, it's important to know how to avoid this and how to kind of navigate through the rules. So what is this TOSI I keep referring to? It's fascinating, riveting topic. So it basically is this concept to stop all this, any income splitting, minors, adults, older parents, anyone. The background of it is pretty much July 18, a bunch of proposals came out. One of them was income sprinkling, which is this tax on split income, this ability to shift income amongst various people. Then there was the restrictions on surplus stripping. I won't go into that, but it's worth to note that came out and that was pulled back on the December 13th in the new legislation. They walked away from that. And then The third one was this tax on split on passive income. So the fact that they said that they would, basically the government found it abusive if you could earn income at low rates and then be able to invest it and earn, have funds in your corporation and be getting a better rate of tax essentially. Now, one thing to note is when the government came out with this, they said that they would grandfather corporations. They did not grandfather corporations. So if you're not aware of these rules, it can be punitive. So it's just something to be mindful. And the legislation became effective for TOSI January 1st, 2018. So TOSI applies right now. So if you have a corporation, or as we'll see, even if you don't have a corporation, TOSI can apply to you. You can be into this set of circumstances. Now, it's also important to note that new information coming out constantly. And when I mean constantly, these rules came out a year ago, and literally yesterday, there was a conference in Vancouver where CRA came out with certain statements that will impact how these rules are understood. And this is literally yesterday. So for as tax guys, I'm sitting there like 5 a.m. this morning reading this stuff. Like, I don't know if anyone else wants to really go through that, but that's kind of the situation. It's an exciting time for tax, really. That's the point to note. So what's changed with this, right? Just to summarize. So we had this Kiddie Tax, now we have this TOSI. So pretty much it's going to apply to everyone. Age doesn't matter. That's the key takeaway. It's going to apply to a lot of people that it wouldn't have applied to before. And it's going to apply to a lot of situations that didn't apply to before. So previously, it predominantly dealt with dividends from private corporations. Creative people came up with ways how to get around that through capital gains plans and through interest expense plans. Those have all been shut down. So they really built these rules to shut down a lot of the kind of more fun planning that we were doing. So how does TOSI apply? We'll specifically define that in a second, but the kind of annoying fact is you're into TOSI unless you have an exclusion. So once you fall into this TOSI, which we'll see is very easy, you need an exclusion to be paying tax at this 53%. And these are extremely complex rules. Like, I'm going to say the definition soon, and no one's going to follow what I'm saying except Nathan. This is like complicated. It came out very poorly. This is something that should be a standard transaction with anyone with a company paying a dividend to their shareholder. You shouldn't have to go through this whole exercise, but unfortunately, current environment, you're going to have to. That's kind of where our Zeifmans pitch. That's where kind of you need that expertise, because this is not something where if you're not up to date, if you're not reading this stuff at 5 a.m., you're going to fall behind. You're going to lose out. So it is important to know that it is complex and you need to be on top of it. So how does TOSI apply? What's this kind of we'll see these three key terms that you need to have for TOSI. So I'm going to say a sentence. No one's going to follow it. Then I'll explain exactly what that all means. So TOSI applies to a specified individual who's related to a source individual who's connected to a related business. That was just crazy. I don't know if anyone even followed that. I barely followed it. So what are those three things? You need a specified individual, right? So this is the person who's really going to be getting the income, right? All they have to be is a Canadian resident at the end of the year. I mean, that should be pretty much everyone in this room. You just have to be Canadian, essentially. If you're under the age of 18, you just have to have a parent resident in Canada. So pretty much everyone is now the specified individual. So you've already hit one of the three key terms. The next thing you're going to need is the source individual. So this is just a Canadian resident related for tax purposes to the specified individual. You have two brothers, one is a source, one is a specified. You just hit two of the three. So again, very low threshold, very easy to have those two met. The third, this is kind of which will pull everything together, is this concept of a related business. Now this concept of business is kind of what's been causing a lot of stir in kind of the tax community lately. It's a big thing for all us tax guys. It's what is this concept of a business? Is a business being carried on? Did we meet this criteria? And there's a lot more depth to it. But it's important to note that you have to have a business, and it has to be this concept of related business to meet that third term. That is, you have to have a business carried on by a source individual, right? So a second person, where the source individual is actively engaged on a regular and continuous basis, right? So pretty much picture your standard circumstance. Dad runs, the company, and he wanted to try to, he's running the company, and he wanted to try to split income with his adult kids, so they're shareholders. So you just walked right into it. Those are the three. Now, what's interesting is Dad doesn't just have to operate. He could operate. That's one way to get caught. Another way is if he owns more than 10% of the shares of the company, he's caught. And if this is a partnership, he just has to have 0.01%. So you can walk into this very easily without even kind of expecting it. So it's a very easy to fall into TOSI. Practically all of the situations where we were trying to split income, where you have a family trust and you have some beneficiaries and you're trying to get a little creative, or advanced tax planning, that's caught by these new rules. So we're going to have to plan how to get out of it. We'll get into that soon. It's important to note that TOSI, this stuff is real. It's going to impact a lot of situations. So let's talk about a high level example, just to give kind of a visual representation of what I just said. So picture the situation. You have this company. You have Harry. He's the son. He's 22 years old. He's in university. He's getting his tuition credits. I'm assuming George, the father, is paying for it. That's why George is going to probably want to, try to split income with Harry, take advantage of his low rate. And they operate this fascinating company, this Diner Co. It surprisingly operates a diner. So what happens in this situation? We got Harry. He's going to be that specified individual, right? He's that guy we were trying to split income with. George, he's the father. He's operating the business. He's that source individual. So right there, boom, you have two of the three. The third one, you just have to have the related business. So George is just operating this diner, right? Boom, you're into the third. Now, he could have also just had 10% of the shares, or he could have also just had 0.01% if it was a partnership. So very easy to kind of just be into this whole TOSI situation. And then in this case, any dividend paid to Harry on those shares, we split income. Harry's at the top rate. He's going to pay 53%. Even if George wasn't. So say George was just making $30,000 a year. This was just an old structure set up. No planning kind of went on. No one thought about it. They said, let's pay a dividend to Harry. Bam, you're at 53%. Extremely punitive. Let's talk about a different situation, which is a little different, but just to show you how easy TOSI can apply. So you have George again. He's back. We now have the diner is a partnership rather than a corp. You have Catherine, his wife. She's going to be the specified individual here. So again, you're going to have George, the source individual. Now, that could either be because George is operating partnership, or because he's 0.01% of the partnership. That'll walk you right into there. Again, you're going to have the diner partnership. That's going to be the related business. Now, what's interesting about this situation is here, visually, you're seeing it as a partnership. So you're picturing probably, or the tax dealer are picturing, there was a general partnership agreement, maybe there's an LP agreement. But what can happen is picture a situation where you have George and Catherine, and they just simply own, they're in the business of flipping real estate. They live, Finch and Bathurst, or now actually like Glencairn and Bathurst, a lot of homes there. And all they do is basically they buy some homes, they renovate them, they flip them, right? And they're doing it right. They're not trying to be overly creative, claiming capital gains or principal. They're reporting this as income. So what happens if George is the one who's predominantly doing the work, and Catherine we're just really putting her there so that we can take advantage of her low rates. So you'd have TOSI in that case, right? No T5, no dividend, no anything. You just have two people with a personal tax return, and you have TOSI. So some situations where you're not expecting it, you can just walk right into TOSI. So it's really important to note that it can kind of creep up on you in a lot of situations. So I've talked a lot about what TOSI kind of is, a little bit of background on a high level. So what's important to note is once you've walked into it, how do you get out of it, right? So we're not going to go overly in depth on this. I don't think anyone really wants that kind of depth. It's important to note that we have the kind of the knowledge there, and we understand these rules. But pretty much there's 5 general exclusions to get out of this TOSI. Unfortunately, what happens with TOSI again is, just to stress it, is once you're in it and it's so easy to fall in it, you have to get out of it. So pretty much TOSI is going to apply unless you have one of these exclusions. So what are these exclusions? So the first one is this excluded share exemption. This is one that, this and the second one, this excluded business, those have really been the focus of kind of CRA commentary and finance coming out with stuff. So this is where kind of the tax guys in the room get all excited. So how do you get this excluded share exclusion? So you need to meet the following criteria. You have to be 25 in the current year or older, right? You can't be a service business. So all of us accountants, we're out. Anyone who, just consulting, etc., you're out. And you can't have a PC. So this was specifically targeted against professionals, accountants, lawyers, doctors. So you can't use this exemption. The next criteria is you have to have more than 10% of votes and value. So this would be, picture a situation: you have a manufacturing company. You're going to want to split income with your wife. So you give her 10% of the shares. Suddenly you can split income with her. So what happens is that you have to give them 10% of votes and value. So that's a little hard to do in some cases. Maybe you have a 27-year-old who you want to split income with. You're going to actually have to give them 10% of the votes in the company. Not something you generally want to do, or generally people are doing. People might now have to do it, but it's a decision to make. So it's not going to be so easy to fall into. And the fact that you can't have a service business, a lot of businesses are really going to be out of this exemption. And there's certain rules in place to not allow you to basically pay income from one company to another to try to fall into this exclusion. The next one, this excluded business one. So this is going to be really meant for the common situation. You have, Mr. Smith, he's been running a factory selling widgets, or he's a consultant, selling certain services. He's the one running the business. It's really him behind the show. That's really what this excluded business exemption is for. Now, people are going to try to fall into it in a lot of cases. It's going to be more of a question of fact in a lot of situations. But this exemption really is meant for that. So what it's there for is if in the current year you're actively engaged on a continuous basis, or if it's a capital gain, you just have to have had any of the 5 previous years, and they don't have to be consecutive. You're in. That's it. You met the exemption. You get a dividend. You're out of TOSI. Now, so what does this mean? Actively engaged on a continuous basis. CRA came out with this bright line test. This: if you work more than 20 hours per week of work during the portion of the year the business operates, assuming, picture a seasonal business, snowplow or something, you're good. Now, does this mean that if you work 15 hours a week, you're not? It's a question. It's always going to be a question of fact. But more often than not, where we're trying to split income with, the 22-year-old who's doing bookkeeping or technology, those situations are going to be really a question of fact. I don't know how much technology the 22-year-old is doing. Are they going to really be doing 15 hours of computer work a week? I mean, it's really going to be a question of fact. But it's going to be more often difficult to fall into if you're trying to fall into it. Now, that doesn't mean you can't fall into it. It's just going to be, again, a question of fact. So it's going to be subjective, really. It's not kind of the second rule you want to fall into after the excluded share. So the third one is this reasonable return. So this applies for if you're over the age of 25. It's reasonable relation to contributions, not just monetary. So you have a husband and wife. The wife pledged guarantee for the business, or she mortgaged the home. Those are real risks. Those are contributions. So you would calculate the reasonable return on that. How you're going to actually calculate this return, again, question of fact. And if it's between the ages of 18 and 24, it's got to be arm's length capital. So you can't simply lend money to your 20-year-old for him to lend money to the business. It's got to be his own money. Again, difficult to fall into. The next one is if you're over the age of 65. So pretty much this is to allow a kind of a form of pension splitting almost. Essentially, if the primary person was actively engaged in the business and now they're 65, their spouse can apply for this and get this exemption. Now, you can have a younger spouse. So if one spouse is 65, the other spouse is 30. Firstly, that's awesome. That's great. But you're into this. So it's a good exemption that's there. Now, the next one we call unique exclusions. These are less common, so I'm not going to really go too in depth or anything like that. It's important to know that they're there. They deal with kind of situations on death, inheritance, settlement from the marriage breakdown, hopefully not due to the older spouse, that whole thing. But and then sale of qualified small business corporation shares. So that's a great exemption there, because you don't actually have to use your qualified small business corporation exemption. You don't have to use that exemption. That's the $850,000 approximately exemption you get on your shares. You don't have to use it. You just have to qualify for it. So if you qualify for it, you can get into some planning opportunity on how to take advantage of that exemption. So that's kind of a high level of what TOSI is, kind of how to get out of TOSI. Nathan's now going to talk about some specific examples to see how this actually plays out into a kind of not a real life situation, but like our make-believe situation. So I'll pass it over to him now.
Thank you, Jonah. Good morning, everyone. So as Jonah has said, we need 3 criteria to fall within the TOSI rules. First, you need a specified individual who's related to a source individual that's connected with a related business. So in my example here, we have an operating company that's owned by usually 25%. Mr. Smith, who's actively engaged in the company, wife, Mrs. Smith, not active in the company, same with the son, Harry, who's not active in the company. The remaining 25% is owned by a family trust, of which the 2 daughters are the beneficiaries of the trust. So right now we have everyone's related. So we got a specified individual, they're all Canadian, they're all related. Mr. Smith works for operating company, so now he's a source individual. When you see the criteria, he operates, he's actively engaged in the business. So now there's a related business, we follow the TOSI rules. So now we gotta get out of the TOSI rules. But let's say there's a dividend paid from the operating company to Mr. Smith. His off-ramp from the TOSI rules is that he's actively engaged in the business. He gets the excluded business exemption. He's fine. Mrs. Smith and Harry, who are not active in the business, they won't get the excluded business exemption. They won't get the excluded share exemption either, because of Mr. Smith, who owns more than 25% of the operating company. So they are subject to TOSI unless they get another out, such as a reasonable return on their investment of whatever they invested into the company. For the 2 daughters that own their investments through the trust, again, excluded business is not applicable to them because they don't work there. Neither is the excluded share rule, because in addition to Mr. Smith being operating a company and owning more than 25%, they are not considered to own the shares directly. It is the trust that owns the shares. So they don't own these shares, and they can't get the excluded share exemption. So they can only use the reasonable rate of return exemption, depending on what they invested in there. Or in the case that they do sell the shares sometime in the future, and those shares qualify for a small business deduction, QSBC, qualified small business corporation exemption, then the gain on those shares won't be subject to TOSI. And my second example, let's say we have an operating company. We have 4 siblings who each have a holding company that owns 8% of the operating company. The operating company pays dividends to their respective holding companies. Holding companies every once in a while pays a dividend out to the respective shareholders. In this case, with the 8% ownership, so we fall within the 3 criteria. We got the 4 people who are related, but we don't have a source individual here, because no one works for the company. In my example here, no one works for the company, nor does anyone own more than 10% of the company. So we have no source individual here. We're out of the rules, so we're fine. Let's change this up a bit. Let's say the operating company was a partnership instead of a corporation. With the partnership, doesn't matter how much percentage you own, even as 0.01%, you're caught by the TOSI rules. So if it's a widely held partnership, you're kind of screwed here, unfortunately. Let's go on with a different example on this. Exact same structure, but let's say Harry wants to destructure his life, quits his job, and he wants to work for the operating company. The operating company is a manufacturer of frozen foods, and he decides to work in the shipping department 15 hours a week. Now he's actively engaged on a regular basis in the operating company. He is a source individual who's working in the business. That creates the TOSI for everyone. Everyone falls under the TOSI rules. So since no one is working in the company, for the 3 siblings, Jay, Nicole, and John, the excluded business rule does not apply because they don't work there. Neither does the excluded share rule because they only own 8%. because you need more than 10% to get the excluded share exemption. So they can rely on reasonable rate of return depending on how much was invested in the operating company through the holding company. Harry, you would think he should get the excluded business rule because you think, oh, he's working there. But there's a difference in the definition. To get caught within the TOSI rules, you need an individual who's actively engaged on a regular basis in the operating company. But to get the excluded business exemption or excluded business off-ramp, you need to be engaged on an active, regular, and substantial basis in the operating company. Whether working in the shipping department for 15 hours a week is a substantial contribution to the business, not, we just don't know. It probably won't meet that requirement. And as Jonah said, there's a bright line test where CRA says that if you work more than 20 hours a week, you meet that test. But he's only working 15 hours. So he's really hasn't met the CRA bright line test. Whether we meet it or not, we have to depend on the facts, and we just don't know the answer to that. My third example here, let's say we have an investment company. All it has are investments in listed securities with a broker at one of the major banks. In the prior years, it had operated as active business. The original owner was Mr. Brown and Mrs. Short. They were brother and sister. And the active business was wound out many years ago. They just decided not to continue with the active business, sold all the assets, and that's how they got the capital for their investment business that they're in right now. Mr. Brown was actively involved in the business. Mrs. Brown was not. And Miss Short, who was a sibling of Mr. Brown, was not involved with the business. Miss Short died, and her husband inherited her shares. So in this situation, we got the TOSI rules applied because of Mr. Brown. He's related to Mrs. Short, and they fall within the TOSI rules. So let's look for our off-ramps. Mr. Brown, he was actually engaged in the business, so he included the business rule. He's fine. Mrs. Brown, again, not active in the business, so she's no excluded business exemption there. And she doesn't get the excluded share rule either because she only owns 1%. You need more than 10% of the ownership. So for her, there are other off-ramps for her to get away from TOSI. If Mr. Brown was over 65 years old, because the dividends to him are not subject to TOSI, then the dividends to her would not be subject to TOSI. That's assuming Mr. Brown was over 65 years old. Or let's say Mr. Brown had passed away and she inherited his shares. Because the dividends received by Mr. Brown, if he had received them, were not subject to TOSI, the dividends paid on those inherited shares would not be subject to TOSI also. It kind of follows with the predecessor. For Mr. Short, so he doesn't need the exemption, but he does own more than 25% of the investing company. So the question comes whether he would need to exclude a share rule. Now, there's another bit of a debate within the tax community. There's conflicting views from CRA, responses from CRA, and what the answer to this is. Some people are arguing that in order to fall within the TOSI rules, you need a related business. And people are saying, well, if you just have a portfolio of business stocks, are you really in the business? You're not doing anything. So if there's no related business, then you should not fall within the TOSI rules. But CRA does not agree with this. That's a whole entire argument to be had. Another question is, with the excluded share rule, one of the criteria to meet the excluded share rule is that less than 90% of your income has to be from a service business. Now, since the investment company, they can say, well, we're not earning any business income here. Would you meet that criteria? CRA said, no, you don't. Because they're looking at it from a formulaic point of view. If your service business is zero and your business income is zero, services business cannot be less than zero. So from looking at it from a formula point of view, you can't meet the excluded share rule. So CRA said no to that. But then later on, they said, okay, in a situation just like this, you sold the active assets of the business. Now you have passive assets. They say, well, if you are running a business of earning passive income in a situation like this, then Mr. Short would meet the excluded share rule because he's in the business of earning portfolio dividends or passive income. So a dividend paid from the investment company to Mr. Short would not be subject to TOSI. So very confusing. CRA said one thing, next week they say another thing. It's changing. We just don't know what the proper answer is, unfortunately. As Jonah was saying, these rules, though it should be simple, they're not written very well. Moving on from the TOSI rules, let's talk a bit about the small business deduction. CRA, finance had a problem with the individuals earning income from in a corporation. So the tax rate in a corporation is 26.5% of the general rate. And if you are eligible to claim a small business deduction, you get this 13.5% of the first $500,000 of income, of active income. Compare this to the top marginal rate for a person at 53%. A person earning income in a corporation has more after-tax money because of much lower tax rate. And with that after-tax money, people are investing in passive income. CRA didn't like this. Didn't like this tax deferral. There's nothing wrong with it. It was just a tax deferral, and CRA wanted to get rid of this advantage. So what they have introduced is this new term called adjusted aggregate investment income. So what or AAII. So what AAII does, it grinds down your small business deduction by $5 for every dollar in excess of $50,000 of AAII. So to look at AAII from a consolidated basis for all associated companies. So if you have many companies that are associated, you look at the AAII for all your associated companies to determine the grind down. Now, what is an AAII? You start off with your investment income, and you subtract from it capital gains from the sale of active assets. Active assets would be assets used in active business in Canada, or connected shares of a connected corporation, where more than 90% of the assets are used in active business. So that's what an active asset is. From AAII, you also would need to add back any capital losses that you have obtained in the year, or any foreign tax credits from your foreign accrual property income. It also includes insurance income from an insurance policy. So basically, they're looking at your passive income for the year on a consolidated basis. And this grind down starts on January 1st of 2019. So people may want to try to get around this rule by lending money to another corporation. So let's say you lend money to a related corporation who's not associated. Again, like I said, the AAII calculation, they look at it from all the associated companies, but not related companies. So CRA put a rule in saying that if you lend money to another company that's related to you, and the main purpose of this loaning of the money was to reduce your AAII calculation, they're going to deem those two companies to be associated. So you go try to do a little trick to move money around, it's not going to work. Moving on to refundable dividend tax on hand, or RDTOH. Again, CRA did not like these deferrals that were available to corporate shareholders. In a situation where you had a corporation who could pay an eligible dividend versus non-eligible dividend, the tax rates are different between those two. There was a potential of 6% tax savings on paying an eligible dividend versus a non-eligible dividend. So CRA introduced two new RDTOH rules. One called the eligible refundable dividend tax on hand, or ERTO. The other one called non-refundable dividend tax on hand, or NERTO. So your ERTO is just made up of your taxes paid on your eligible dividends, or on your taxes paid on dividends received from connected corporations to the extent that they receive a refund from the ERTO account. You can get a refund from your ERTO account for the payment of both the eligible or non-eligible dividends. And for non-eligible dividends, basically consists of your Part 1 tax, or all your taxes paid on your portfolio dividends, on non-eligible portfolio dividends. And dividend refund for your NERTO can only be received for the payment of a non-eligible dividend. So these rules come into place January 1st, 2019. So on that date, you need to calculate your ERTO or NERTO account. Your ERTO would be the lower of the RDTOH account, or 38 1/3% of your general rate income pool balance. And your NERTO, whatever balance remaining of your RDTOH account, would go to your NERTO. And if you were not a CCPC throughout the taxation year, everything in your RDTOH account goes to your ERTO account. Again, CRA put in rules to prevent you from trying to circumvent these new rules. So this applies to both the small business deductions I was talking about earlier and the new RDTOH rules, such that if you did a transaction that created a deemed year-end in 2018, so that you got 1 extra year deferral from preventing these new rules from applying, the CRA will have these rules apply to that short year-end. And moving on to the trust disclosure rule. So currently, under the trust disclosure, a trust is not required to file a tax return if it does not have any taxes owing or did not distribute capital to the beneficiaries. So there's no requirement to file. CRA introduced new rules saying you have to file unless you find a way out. They did this because they want to make sure everyone is being assessed the proper amount of tax and to get a better idea of who owns these trusts and get a better gauge of what type of trusts are out there. So starting December 30th, for year ends after December 30th, 2021, you have to file a trust return unless you find a way out. Basically, a way out, they said, is if your trust is less than 3 months old or your trust has less than $50,000 fair market value of assets of a list of certain types of assets. I'm not going to go through an exhaustive list here, but there are assets such as cash, government bonds, listed securities. They won't include your TFSAs, RSPs, or trust accounts created by lawyers to hold funds and trust for their clients. So those trusts do not fall within these rules. Now, with the new disclosure, with the new filing, there are new disclosures that you have to give to the CRA. The new disclosure is that you have to give the names, addresses, tax jurisdiction, and the social insurance number or tax identification number for all the beneficiaries of the trust. In addition to that, they want the same information for the trustees and the people who have influence over the trustees. So now you're wondering, what's the big deal by giving this information? It's a very simple process for CRA to link your social insurance number to a corporation out there. Because one of the information requirements, if you own more than 10% of the corporation, you're supposed to disclose the shareholder with their social insurance number. Easy for them to link with a disclosure from the trust to see who is associated. So a lot of people miss the fact that when you have a trust, the beneficiaries are deemed to own 100% of the shares held by the trust. So for example, you have three children who are the beneficiaries of the trust, and the trust is the sole owner of a corporation. Each of those three children are deemed to own 100% of that corporation. So now you may have an association rule that now could be controlled by the kid. Also, the trustee, he's also deemed to own all the shares of the trust. So it's very simple for CRA to see who's associated. And with association, again, like I was saying, it affects your small business deduction. It affects other items such as your RG tax credits for research and development. Again, CRA introduced new penalties and new rules for the trust disclosure. They have the old late filing penalty of $25 a day, so a massive $2,500. But they also introduced a new penalty, such that if you make any false representations or fail to comply with the demand to file, there's a new penalty of the greater of $2,500 or 5% of the fair market value of the assets of this trust at any time of the year. So it's pretty punitive, this penalty. CRA really wants this information. That's why they put it there. So I'll head back to Jonah, who will discuss some of the planning opportunities that we have to get around some of these rules.
Awesome. Thank you, Nathan, for that. So I'm going to now talk about, just on a high level, some of the kind of more common questions that we've been getting. And we're going to talk about what we're seeing in our practices and what we're kind of seeing as ways to kind of navigate through these various rules and how we can kind of get through them. So let's talk about first, common question we're getting is, do trusts still make sense? So as we heard at the very beginning, if you have more, if you want to fall into that excluded share exemption, you have to actually own the shares directly. You have to have more than 10% of votes in value. So if a trust owns, let's say, the common shares of a company, you can't fall into that exclusion. So some people are saying, well, why don't I wind up the trust, distribute the shares to the beneficiary? So keep in mind, you have to give them 10% of votes in value. Now, are you going to really want to give your 22-year-old 10% of those voting rights of your company? Not necessarily. You might be holding those votes as what's known as super voting pref shares. So it's something to think about. In a lot of cases, a trust still will make a lot of sense, particularly when the trust is there for estate purposes. Because while a trust might have been created for the ability to split income, you're also having the ability to shift value to the next generation if you previously had done something known as an estate freeze. So it can still make a lot of sense. So while you're not able to split income this method, you're still passing on all this future growth to them to be taxed by them. So it can still make a lot of sense. I'm going to talk about in a few minutes about a strategy known as the prescribed rate loan strategy, which makes a lot of sense still. The next question we'll get is, do holding companies still make sense, or investment corporations? So again, a lot of uncertainty with this. As we mentioned, new commentary coming out constantly. Just yesterday, commentary. It's a big debate kind of going on. My view is that it does work if it's an investment company. I shouldn't say that it does work. It can work in a number of circumstances if you make sure that the facts lend itself to the situation. So it can still make a lot of sense. If you have an investment company, this is a great time to kind of reach out to your advisor, speak about the impact of this and situations where we can make sure that you're falling into this situation to get the exemption. Now, it's also important to note, how is TOSI assessed, right? Say you're the shareholder of a family company. Every year you get a nice little T5 from the company. Hopefully the cash comes along also. And you're wondering, well, did TOSI just apply on this? So it's actually made at the shareholder level. You'll have to determine, did TOSI apply on this? A lot of times you might not even have the facts to be able to do that. How this is going to be enforced, how you're going to go about getting that information, it's new. We don't really have the answers to that. But it's just important to note that that is where TOSI is assessed. It's at the shareholder level. And then one last thing just to mention is, in terms of that small business grind, that where you earn over $50,000 of passive income, you're going to lose the small business deduction. So the other week in the Ontario budget, the Conservatives announced that Ontario is not going to be following the federal position. So it's actually interesting. It's not as bad as what initially was thought to be. In fact, when you actually run the numbers all the way through, so earning the income and paying it out as a dividend, it can actually be 5% ahead of the game. So there's actual savings there. How this is going to be enforced, we don't know, since typically Ontario and the federal, it's one tax filing. But it's at least good to know that there's some pushback there and actually some changes. Now, how to navigate these rules, right? What are we seeing in our practices that people are doing to kind of combat this? So the first thing, and the insurance guys in the room are going to love this, is insurance, right? This is a huge space right now. It's booming for them. I know there's a few great insurance guys here. I'm sure they would be more than happy to talk to anyone in the room. And what kind of plans are we seeing with insurance? So the first one we're seeing is a big push to leveraged policies. So where people are having a corporate policy and perhaps they're leveraging in a manner to extract corporate surplus. It's known as an immediate finance arrangement. Another version of it is known as personal secured financing. These are methods to extract larger amounts of capital out of a company on a more tax advantageous basis. Now, they're not without risk, but they are fairly good strategies that people who are in this situation might want to consider. We're also seeing a big push to what's known as a critical illness return on premium strategy, where basically you have a split dollar arrangement between the shareholder and the corporation, allowing the shareholder to basically extract corporate surplus. We're also seeing a big push just to regular whole life policies, and also to private placement universal life. These are strategies where essentially you're able to have your investments inside of a insurance wrapper or insurance vehicle. So the income earned, A, it's not taxable, but B, it doesn't impact the small business grind. So you kind of get the best of both worlds. And then actually on the death, it'll pay out to the CDA account, the capital dividend account. So you'll actually be able to extract the corporate surplus. So great strategy. We're also seeing a push back to older plans, surprisingly, like individual pension plans and retirement compensation arrangements. These are kind of making their comebacks. Also great strategy. We're also seeing people moving just to capital gain strategies. So perhaps they were in a yield portfolio. So they're saying, well, this small business grind is on an annual basis. So why don't I shift my focus from having annual yield income, which will grind this, to kind of a more capital approach where maybe every 5 years I'll trigger a gain and I'll only have this grind once every 5 years. Again, the investment decision kind of has to have its own merit, but that's what we're seeing. We're also seeing just a push predominantly due to this 53% personal tax rate to more aggressive tax plans. So people are kind of taking more risk. Perhaps they're moving into capital gain strip plans, or they're moving into strategies to use their QSBC exemptions. But there's definitely been kind of more aggressive plans out there than typical. We're also seeing a push to salaries and director fees. So people who were paying, maybe they're paying their 22-year-olds, 40 grand out of their company as a dividend, they're saying, well, I'll just pay him the salary now. So it's important to note it needs to be reasonable. If it's not reasonable, there are certain sections of actions will deny the expense to the corporation. Now, there's an interesting article someone wrote talking about, well, if it is denied, what happens? Maybe you're better off just from a numbers perspective, since you still got the money out of the company. Other people are saying, well, maybe that'll imply a shareholder benefit. It's a strategy worth considering. If you're on the less aggressive side, definitely want to be able to make sure that that salary is reasonable. Another big push we're seeing is for non-residents. So say you have a family trust, or say you have a non-resident shareholder. Perhaps your kid is, your 22-year-old is, or not even 22, maybe they're, a sibling, and they're in a non-tax jurisdiction. Maybe they're in Cayman, maybe they recently immigrated to Israel, or perhaps they're just in a lower tax rate jurisdiction. When you pay them a dividend from the company, you're going to have withholding tax levies, but no TOSI. So say that they were in Cayman, for example, and they're not taxable there. Pay them a dividend, there's withholding of 25%, but that's it, no tax. So you're better off in that case than paying it to a Canadian where you'd be up to the 53%. So this is something to consider, something to think about. Also, it's fact specific. Can you be into that situation, but also a great strategy. We're also seeing people who are close to age 65. So say you're 63, they're maybe waiting until they're 65 so that they can split income with their spouse. So maybe they're keeping more cash than they typically would distribute. Just keep in mind small business grind. What's that cash doing? If it's being put into investments, maybe it's going to add into more investment income, which will push you over that threshold. And then the last thing just to mention is the prescribed rate loan strategy. Now, I mentioned this a little bit before, but this strategy is a great strategy that is kind of blessed by CRA. It's it's kind of the last way to really income split. So what happens in this case is that it's me. I have I can even do it with minor children. So I have a 3.5-year-old, a 1.5-year-old. I set up a family trust. They'll be beneficiaries. I will lend money to the trust. All I have to do is charge a prescribed rate loan, currently 2%. Anything earned in that trust can be allocated to the beneficiaries. So that could include, I could have a corporate beneficiary. I could have my older parents as beneficiaries. I can have my minor kid. And it's taxed at their rates. So you can still income split in that method. It's just not at the corporate context. So it's going to be, again, fact specific. But if you're in a situation perhaps to pull cash out at a low rate from your company and invest in this manner, you can still income split, and it's a great strategy. So with that, we'll kind of wrap things up. Nathan